Hey guys, Sunday Dupont here and welcome back to my channel. And in today's video, I will be talking about the most common investments that investor beginners they make here in Canada in order to prepare for financial independence and to retire early. And remember, I do not act as a financial advisor in these videos, they are for entertainment purposes only. Don't forget to like, subscribe, and leave a comment below, and I will see you in the next video. Enjoy this video. What is investing? Every time you put money down in the hope of receiving a profit in the future, this is investing. In Canada, there are countless ways that people can invest. But today I will be talking about some of the investment we can do through financial institutions like banks, credit unions, or online trading platforms. One important detail that you need to know is that when you invest in Canada and you make a profit, the government is required that you pay taxes on that profit. However, one thing that you can do to avoid that, because you need the most money as possible so you can retire early, is that you can invest the money in a tax-free savings account or in a registered retirement savings plan. If you didn't watch my previous video about this, you can look in the description up here, and I will also leave the link in the description below so you can go back and watch this video about RRSP and TFSA, how you can grow your money either tax deferred or tax free. Now let's start talking about different investments. Before I actually talk about different investments, one of the best investment that someone can do, and that has probably one of the best return, is if you have credit cards debt, you pay the credit card debts, because most credit cards out there start about 19 to 21%. So that means if you're carrying credit card debt, that means you're paying the financial institution that issued that card about 21% of your, or sometimes it's more, of your money. So now if you have that debt and you pay it back, so it's like you're getting 21% staying in your pocket. So that's one of the best investment out there. So if you have any credit card debt, before you even think about saving and investing money, that's the first investment that you need to make, is to pay those debts down to zero. So this way you're not paying any debt towards the credit card company, but you actually keeping this money in your pocket in order to save that money for yourself. Number 2, savings account. A saving account is an account where money can go in and out at any time without any penalty. You get a little bit of interest by having money sitting in a savings account. So because this account is safe, usually you get a small amount of interest, because in the financial world, usually less risk means less reward, and higher risk also means higher reward. But we will be talking about that later. A savings account is also protected by deposit insurance here in Canada, which means even if a financial institution were to go bankrupt, if you have under $100,000 in a savings account, you're guaranteed that money is protected. When would I put my money in a savings account? Well, a savings account is for money that you will be needing in the short term. For example, if you were saving to purchase a car, or your emergency funds, money that you want to have access to at any given time, and also because you know the value of that money will not go down when you need to take it out, then you would put that money in a savings account. Until sometimes last year, a regular savings account on average had 0.05 to 0.10% here in Canada. So it's not a lot of interest in there. However, because the money in there is accessible at any time, if you need money to be liquid, it's best to keep it in a savings account. But right now, because the interest rates are high, you can have an average between 0.75 to 1% of interest rate in a savings account, which means you're making a little bit of money, a little bit, because on a checking account, if you were to leave your money there, you're not getting any interest at all. So it's best to put money that you will need in a short term in a savings account. Number 3, GICs, or Guaranteed Investment Certificates. These are investments where you have a fixed interest rate. What that means is that during the term of that investment, you already know in advance how much money you're going to receive because a predetermined interest rate was calculated for you. So what that means is, let's give you an example. If you want to invest $100 for a 1-year term, and they tell you for 1 year they will give you 1% interest. So that means if you invest $100, after 1 year, that $100 will become $101. It's important to know that some financial institutions call GICs differently. Some of them call them CDs or certificate of deposit. Other places call it term deposit, and other places also call it term savings. They all mean the same thing. So it is an investment where you put a bulk of money at once and you determine how much the term is gonna be. GICs are protected by deposit insurance up to $100,000. So that means even if a financial institution were to go bankrupt, if you have a GIC that is under $100,000, it is automatically protected. Number 4, bonds. You probably heard of words like stock market, bond markets, when you often ask yourself, what are bonds? Well, let's say the federal government or provincial government or a municipality or even companies, they want to raise money to come up with a project. They have the project, but they don't have the money for it. They decide they will issue bond securities or debt to investors that are willing to take on those debts. So they want to borrow money from investors in order to make this project come to pass. So therefore, they issue bonds. There are different types, but to keep it simple here, let's say, for example, you buy a bond that has a face value, so which means what it will be worth in the future, that is $1,000. For 5 years, they say if you buy this bond for $800, that is, the face value is $1,000. So that means in 5 years from now, your $800 that you bought this bond for, you will be paid $1,000. So you make a profit of $200. So a bond, during the life of the bond, you can also trade it. You can sell the bond, you can buy bonds that were already issued from other people. But again, to know if bonds are important or part of your financial plan, it's important to talk to your financial planner or financial advisor. They can help you with that. And if you're a personal investor, you can make your own research to know if bond would be a good part for your investment portfolio. Number 5, mutual funds. Mutual funds allow you to pool your own money with other investors mutually to invest in a fund that carries either stock, bonds, and other securities, or a combination of them. They are usually managed by a manager, a fund manager, someone who is a professional, who know what they are doing, when it's time to sell, when it's time to buy, what to buy, when to buy. So technically, when you invest money in a mutual fund, you give your money to a fund manager, technically, to invest the money for you, that do all the different aspects of buying and selling, and while you just sit in the background and enjoy whatever you get as a profit or as a loss as well. So when you invest in a mutual fund, you can make money, you can also lose money. So that's why it's important for this type of investment to make your own research if you're a personal investor, or you talk to your financial advisor to know if mutual funds are good for you. And there are different types of mutual funds, but we want to keep it simple. So you put money together with other investors and you invest in a fund that is managed by a fund manager who is a professional, who knows about the market with analysis and things like that. They usually work in teams, so this way they know how to best manage the money for your own profit. So different than a term deposit or GIC or even a savings account, mutual funds usually have fees. So technically you pay a fee to pay those managers, fund managers that are managing the fund for you. Number 6, stocks. What are stocks? Companies that are publicly traded, which means it's not a company that's owned by a family, but that can be owned by everybody that are willing to buy their shares. Those companies sell their shares and you can become part owners. Sometimes you hear the word stocks or shares or equities. They all mean the same thing. So what that means is that, let's say for example, one company and one stock of that company is worth $100. So today with $100 you buy one stock or one share of that company. So that makes you a part owner. You can buy more. But what happened is, when this company makes a profit, you make a profit as well. And when the company is losing money and the price of the stock goes down, then your money is going down as well. One thing that's important to note is that when you invest in the stock market, you don't actually make or lose money until you decide to sell your stocks. What I mean by that is, the stock market always go up or down at any given time. So let's say you buy for that $100, you have one stock. So let's say tomorrow you wake up and you saw that this stocks, because people are willing to buy that stock for $102, so that means your stocks is worth $102. However, you didn't make $2 because you didn't sell those stocks. So you didn't actually make a profit until you decide you're going to sell the stock. And same thing, if you wake up tomorrow morning and you realize the stock is worth $98, you didn't lose $2 because you didn't sell this stock. So you only make or lose money on the stock market when you decide to sell your stock. You can either sell at a profit or you can sell at a loss. So if you want to know if stocks is part of the things that you need to invest in, then you can make your own research if you're a personal investor, or you can talk to your financial advisor to know if stocks would be a good fit for your portfolio. There you have it, guys, some of the most common things that people in Canada invest their money in. And in next video, what I will do is that I will tell you exactly what type of investments that I personally put my money in and how they're doing, and I will explain that to you in future videos. So stay tuned, don't forget to like and subscribe, and we'll see you next week for another video.